You are at checkout with a purchase worth $135 in your cart. Maybe it is a pair of shoes, a small appliance, or something else you did not plan to finance until the payment screen offered you a choice. Pay $135 now, or make 4 interest-free payments of $33.75. Same product, same total price, no interest, and the store still gets paid without waiting 6 weeks for your final installment. So, who financed the gap? The answer is the merchant. Buy now, pay later companies charge the store for the transaction. But before we follow that fee, look at how strange this business becomes at scale. In the second quarter of 2026, Klarna moved $36.6 billion of purchases through its network. It recognized $1.042 billion as revenue. After technology, marketing, customer service, administration, and the other costs of running the company, operating income was $27 million. Net income was $9 million. $36.6 billion moved through the network. $9 million reached the bottom line. That leaves 4 uncomfortable seats around the same checkout. You see free short-term credit. The merchant gives up part of the sale. Klarna handles billions of dollars, but keeps only a thin profit. And somewhere outside the receipt, a funding system supplies the money that lets the merchant get paid before you finish paying. How can this feel free to you, expensive to the merchant, and still leave so little at the bottom? Follow one order worth $135. That amount is close to the average size reported in recent United States data covering 6 major pay in 4 providers. You pay $33.75 at checkout. Then you pay the same amount after 2 weeks, again after 4 weeks, and one final time after 6 weeks. If every payment arrives on time, you pay exactly $135. From your side, the financing really can be free. Now look at the same purchase from the merchant's side. The exact contract is private and varies by merchant, product, and volume. But a Stripe guide published in 2026 lists general Klarna transaction fees ranging from 3.29% to 5.99%, plus 30 cents. On this example, that would be roughly $4.74 to $8.39. The merchant might receive somewhere between $126.61 and $130.26 before paying for the product, shipping, returns, marketing, and everything else required to run the store. That fee is revenue to the payment system. It is not pure profit for the buy now, pay later provider, but the direction of the money is clear. You receive the zero-interest loan. The merchant pays for it. Why would a retailer volunteer to lose several dollars from a sale? Because the alternative may not be a full-price card transaction. It may be no transaction at all. The product still costs $135, but the checkout button emphasizes $33.75. The total price has not changed. The size of the immediate decision has. In one randomized experiment summarized by the National Bureau of Economic Research, offering Buy Now, Pay Later increased the share of shoppers who completed a purchase after adding an item to their cart from 70% to 80%. It also led shoppers toward higher value items, increasing sales by 20% in that setting. That is what the merchant is buying. The loan is the coupon. Conversion is the product. That is one experiment, not a promise that every American retailer gets a 20% lift. But it explains the merchant's logic. If a fee rescues enough abandoned carts or raises the average order, it can behave less like financing expense and more like performance marketing. Be honest. When a checkout offers 4 payments, do you compare the full price or the first installment? Put that in the comments. Then come back to the merchant, because its decision only works under one condition. The extra sales must be genuinely extra. If shoppers would have bought the same products anyway, Buy Now, Pay Later has not created revenue. It may have replaced a cheaper payment method with a more expensive one. In that case, the merchant is paying for conversion it already had. So the merchant fee explains why Buy Now, Pay Later revenue exists. It does not explain how the provider keeps enough of it to build a durable company. A company built on one fee per checkout would be fragile. Klarna's filings show a broader relationship. In the 12 months ending June 2025, Transaction and service revenue represented about 75% of total revenue. Merchant revenue made up roughly 3/4 of that category. Interest income from longer-term financing represented the other 25% of total revenue. Merchant-funded transactions remained the largest layer. But once a consumer is inside the network, the company can also offer longer-term financing, a card, a paid membership, shopping tools, and other services. Pay in 4 opens the relationship. It is not the entire business. That entry point matters because it can repeat. More merchants put the button in front of more shoppers. More shoppers generate more applications and repayment history, and a familiar payment option makes the next merchant more willing to add it. Your first purchase worth $135 is also a test for the next one. Every approval produces a decision. Every successful or missed installment adds another signal. The provider can use that history to decide whether to approve the next purchase, how large it should be, and which customer should receive a longer financing offer. This does not mean the company secretly makes its money by selling your personal data. The more direct value of the data is underwriting. Better predictions can reduce losses, support faster approvals, and make repeat transactions cheaper to price. The valuable control point is the position at checkout and the repayment history that follows, not the 6-week loan by itself. But the provider still needs actual money before your history becomes useful. Klarna pays the merchant quickly and collects most of the purchase price from you later. Your first payment of $33.75 reduces the exposure immediately, but the remaining balance has to be funded while it falls over the next 6 weeks. For Klarna, about 90% of funding in the middle of 2026 came from relatively low-cost consumer deposits. Depositors supply capital and receive interest. They do not underwrite your checkout. Klarna does, and Klarna remains responsible for default risk. The deposits fund the loan. The platform carries the credit risk. That distinction matters because funding cost is one of the narrow spaces between revenue and profit. A provider using more expensive wholesale money has less room. A provider with cheaper funding can price more aggressively or keep more of the fee. Then come the other transaction costs. 4 installments create more payment events than one card purchase. Each payment must be authenticated, collected, reconciled, and sometimes retried. The provider also services disputes and makes provisions for customers who do not finish paying. The United States market is growing quickly. The Federal Reserve Bank of Richmond estimates that pay in 4 transaction value reached roughly $70 billion in 2025, growing about 20% per year in real terms since 2021. That sounds enormous until it is compared properly. It was still only about 1.1% of United States credit card purchase volume. And because customers pay 25% immediately and repay the rest within 6 weeks, the Richmond Fed estimated average buy now, pay later debt outstanding at about $3 billion, compared with more than $1.2 trillion in credit card debt. Buy now, pay later is expanding. It is not replacing the credit card system. And that scale supports a fair counterargument. Buy now, pay later is not automatically a debt trap. For a customer who would otherwise carry a credit card balance at a high interest rate, 4 genuinely interest-free payments can be the cheaper option. A merchant may gain a sale. Recent Federal Reserve analysis also found no clear evidence that buy now, pay later had created elevated stress across the broader financial system. There does not need to be a victim for the model to work, but all 4 seats do need to remain aligned. Now put every layer back onto the same order worth $135. The merchant-facing illustration and the company-wide economics are 2 different views, so they should not be added together. The public fee range showed what one merchant might pay under a particular agreement. Klarna's quarterly ratios show what the company recognized across countries and products. Using Klarna's company-wide ratios for the second quarter of 2026 only as a scale illustration, $135 of gross merchandise volume corresponded to about $3.84 of revenue. After processing, servicing, funding, and provisions for credit losses, about $1.65 remained as transaction margin. Roughly 70 cents of the original $135 was provisioned for credit losses, with around another $1.50 going to the other transaction costs. Technology, marketing, customer service, and administration still came after that. Those are the wider economics behind the example, not a receipt for one specific pay in 4 order. They explain how a visible merchant fee can coexist with a thin bottom line. Start with the merchant. It pays the fee because it expects incremental sales. If buy now, pay later mostly replaces purchases that would have happened anyway, the merchant pushes back, negotiates a lower fee, or removes the option. That puts pressure on the provider's already thin transaction margin. If funding costs or credit losses rise at the same time, the provider can protect itself by tightening approvals. But fewer approvals can reduce the conversion benefit it sold to the merchant. The growth lever and the risk lever pull against each other. Visibility changes the balance again. Buy now, pay later historically sat partly outside traditional credit reporting, making a collection of small plans harder for other lenders to see. FICO has introduced scoring models designed to incorporate buy now, pay later data, although availability does not mean every lender has adopted them. Greater visibility may improve underwriting and reward responsible repayment. It may also make several small plans look more like what they are: several credit obligations competing for the same paycheck. So go back to the checkout screen. 4 interest-free payments of $33.75. You receive time and see a smaller number at the moment of decision. The merchant gives up part of its margin to improve the probability of a sale. Klarna advances funds, processes the payments, prices the risk, and keeps whatever survives its transaction and operating costs. Depositors supply capital and earn interest, while Klarna retains the consumer credit risk. That is the full transaction. Buy now, pay later does not eliminate the cost of credit. It rearranges who pays, when the money arrives, and which number drives the purchase. Buy now, pay later is a merchant-funded checkout system wrapped around a short-term lender. The zero interest is real. The free transaction is not. The next time $135 becomes 4 payments of $33.75, do not ask only whether you can afford the first installment. Ask what changed when the full price became the smaller number beside the button. That difference is what the merchant is buying, what the lender is measuring, and what makes the system work. If you want more businesses pulled apart, one transaction at a time, subscribe. The next breakdown starts at another familiar checkout.